Hi everyone, and welcome to our webinar, the 3 Essential Tools. We'll just wait a minute or two for people to join the webinar. I hope you can all hear me okay. If someone just wants to put in the chat box to let me know that you can hear me. Perfect, thank you. Okay, so let's start. So welcome everyone to our webinar, the 3 Essential Tools. My name is Ikra Aslam and I am the Client Manager here at Ross & Associates, and I'll be the moderator today. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. You can select audio settings to select and test your speakers. You can submit any questions that you've got via the Q&A button, and we'll answer your questions at the end of the webinar. And there is that leave meeting button if you do need to leave the webinar at any time. There will be a questionnaire at the end of the webinar, so please do spend a couple of minutes filling out that for us. Your feedback is valuable to us and helps us to improve our services. I'd now like to introduce today's presenter, Ian McLeish, who is the Director of Ross & Associates. Welcome, Ian.
Thanks, Ikra. I think most people who are attending today know who I am, so I'll just dive straight in. I always like to start these things with a thought for the session. And here we've got Dwayne "The Rock" Johnson saying success isn't overnight. It's when every day you get a little better than the day before. It all adds up. So essentially, there's no magic bullet for business success. It does take hard work. And at the same time, it's hugely rewarding to see the improvements you can make by adopting the 3 essential tools for business success. I'm passionate about small business owners getting more from their business. Doesn't matter what business you're in, the principles we're going to explain today apply to your business. Now, you're all in business for a reason. Take a moment to think about what you wanted your business to give you when you first started. What did you dream it would be like? Now, what score would you give yourself out of 10 for how well the business has delivered on these dreams? 10 being 100% your dreams are reality, life couldn't be better. Or 1, the dream is more of a nightmare and sometimes you don't know why you did it in the first place. Write your score down. If it's less than 10, then maybe today could be the first step to getting nearer to 10 out of 10. I'll say more about first steps soon. Experts at the technical aspects of your business. But today is in part about reflecting on what you're not so good at. Perhaps this is understanding your numbers, or creating and implementing a simple business plan. Perhaps you need to lead the business and team a bit better. These are all things that we can help you with, things you can improve. We want your business to serve you, not the other way around. So what am I going to cover? Actually, before I do that, it's really important that I suggest that you write things down and write some actions down as we go through it. If you come out of this session with 3 actions that you can put in place in your business, that's a huge success. The biggest failure in business is FTI. It's failure to implement. Write it down. Please make lots of notes during the webinar, and if you don't write things down, you won't remember them. If you don't write down your actions, it won't happen. Today, I'm going to share with you the power of 1%, having the courage to change and sharing the formula for change, what the 3 essential tools for business success are, examples of how to use the tools, then it's accountability time, the time when the rubber really hits the road, the time for you to decide what you're going to do as a result of coming along today. I'll show you how adopting these 3 tools in your business can greatly improve your profit and your business value. I really want you to get the maximum value from this session, so if you have any questions, remember to put them in the box below and we'll cover as many as we can at the end. So the power of 1%. Small changes can have an incredible impact on your business. For example, if you increase your sales, by the end of the year, you'd be selling 37.8 times more each day. Put another way, you could double your sales in 70 days by improving by 1% each day. What would your business look like if you doubled your sales? What would it look like if you increased sales by 37 times? Of course, it's unlikely that your sales numbers will grow in such a linear way. And the point here is to illustrate the power of compounding growth. Even if you achieved even just a weekly increase in sales of 1%, then your sales will double in just over 16 months. What we're really looking for is continuous and sustained improvement. Small changes, not magic bullets. Now let's consider what happens if you don't make those changes. Let's say your sales start to reduce by 1% each day. And there could be a whole range of reasons why that might happen. If your daily sales are currently £1,000 and your sales fall by 1% every day, then by the end of the year, your sales will be just £30 a day. Again, your sales or your production or whatever is unlikely to drop in such a linear way, but the improvement, your business performance is likely to drop over time. To quote from Albert Einstein there, compounding is the greatest mathematical discovery of all time. Now, change is inevitable, growth is optional. What does that mean? I think it means that it doesn't matter what you decide. The world is going to change around you. Change will happen. And as the world changes around you and your business, it will have an effect on your business. Whereas growth, which is positive change, is optional. If you can decide if you're just going to let things happen or whether you're going to actually do something to create growth in your business. There are a lot of businesses who haven't actually adapted over the years. I'm just going to give a few examples just to emphasize the point here. For instance, Kodak. Remember when I was growing up, Kodak was Kodak films, Kodak cameras, all sorts of things. And by 1976, they said they had 85% share of the market. But they failed to adapt to change, and by 2003, their market share was right down to 15%. Not many people know this, but Kodak actually developed the first digital camera. But they were worried about the effect it was going to have on the rest of their business, so they didn't do anything with it. Their failure to accept change from film to digital had a massive impact on their profitability and the value of their business. Now most of us carry a camera around in our pockets, instantly uploading them to social media to share with our friends. And by the way, Kodak actually released their first smartphone in 2017. Don't know anybody that's got one though. MySpace, does anybody remember MySpace? It was one of the first social networking platforms and was the largest until Facebook overtook it in 2008. Notice that the world was continually changing. It didn't adapt and change. It kept the same structure, while Facebook and Twitter were updating, adding new features all the time. In 2015, MySpace still had over 50 million monthly users, believe it or not. However, compare that to Facebook's 2.38 billion monthly users and Twitter's 321 million monthly users. And you can see the effect that failing to adapt to change has had on MySpace. And the classic one, Blockbuster. At the height of its success, Blockbuster had over 9,000 stores worldwide. This is just another story of a business that had the opportunity to change, but didn't see the value or the threat. Not 2000, when Netflix was starting out with a mail DVD rental service, the CEO approached Blockbuster apparently to discuss Netflix handling Blockbuster's online business. However, it said that he was laughed out of the room. So these are all examples of businesses who thought they didn't have to change, who essentially were in denial that the whole world was changing around them, in particular technology. So having the courage to change, this is what some people will know as the formula for change. Any mathematicians might point out that it's not quite correct, but it's a mathematical formula, but that doesn't really matter. What the previous examples we gave shows change isn't easy. When things are going well, it can be hard to see the need to change. So we've all got inbuilt habits and behaviors that we repeat. We also have so much going on in our lives that it's hard to start doing something differently. The formula for change will help you increase your ability to change. On the right-hand side, we have an R, and this stands for resistance to change. That is everything that's stopping people from changing their behavior. This can come in different forms, and often there's a lot of different factors involved. Perhaps they have no time, no money, they don't see the benefit of changing behavior. The most common underlying factor I see is fear of something. What you have already, often a sense of holding on tight to what you have and denying the need for change. Not a recommended strategy, as we've seen. You need to build up the left-hand side of the equation so that on the left-hand side, it's bigger than the right. So that the variables on the left amount to more than the right, and then change can happen. So what does D stand for? Dissatisfaction with the status quo. In other words, how unhappy are you with the way things are? And how unhappy will you be if you don't change? And we have to look at that in some detail to see what the implications of not changing are to build up the dissatisfaction. What happens if you don't learn how to grow your business or improve profitability? Profitability may drop, you may not even be able to take that family holiday, or you may have to get rid of some team members. Lots of different possible implications. As well as understanding the dissatisfaction we have to look at a vision. We need to have a vision of a positive future state. What will your life look like if you do change your behavior? What do you want your future to look like? Do you want more holidays, more money, more time with your family? Having a clear vision will help drive you to change your behavior. Finally, the first step. What's the first step you need to take in order to achieve that vision? Remember, the consequences of inaction will heighten your dissatisfaction and cause the business to regress. The fact that you're here today means that you're open to change. So that's a great step in the right direction. The 3 essential tools I'm going to show you now are of a positive future state. As you'll see from this formula, your resistance to change, the R, has to be outweighed by your dissatisfaction with the status quo and your vision of possible future. At Ross & Associates, we've developed some great processes to help you understand your current dissatisfaction clearly, to help you create your vision in a change in your business. You're already taking the first steps by attending this webinar. So with all that change involves in mind, we can now look at the 3 essential tools for business success. We've got the annual business plan, the annual forecast, and ongoing reporting and accountability. You've probably heard about them before, but you might not know exactly what those tools look like. A business plan essentially takes your dreams, your vision, and actions and due dates. The plan becomes your guiding document to deliver you the business outcomes you dreamed. Your annual forecast then takes the budget from your business plan and breaks it down into monthly targets with full details of income and expenses, including tax, drawing, assets, purchases, and loans. Forecast shows you the numbers you need to achieve your desired business outcomes. The ongoing reporting and accountability makes sure you take the action required for the plan to take form in reality. We've all made plans and put them in a drawer or in my case, often some hard to find folder on your computer. Occasionally you come across them again, and actually it could be quite interesting noticing that nothing's actually happened. Unless someone holds you to account, change just won't happen. So who's going to hold you to account? Write it down. So let's start looking in more detail at the actual 3 essential tools. The first one being the business plan. Now, there are literally hundreds of books and articles on the internet about components of a business plan. And here's what we consider as best practice. Firstly, your business plan should have a clear purpose. This should be a 5 to 7 word statement that explains why your business exists for your customers. Secondly, you need to have a clearly articulated vision. What will your business look like in 5 years' time? What do you want to achieve? What does your business need to deliver to you? Remember, your business is there to serve you, not the other way around. State the hours you want to work, the holidays you want, how much money you want to make, all these things. Whatever you want your business to provide for you, get it down there in your plan. The high-level budget that you do in your business plan helps identify your gross revenue, i.e. your sales targets for the year. It is based on what you've recorded in the what we want to achieve section. The budget also forms the basis for essential tool number 2. As part of the business plan, you need to identify some key performance indicators, and these are the things to measure that will make sure you're on track to your goals. For example, it could be daily sales figures, it could be gross profit percentages, or possibly even the number of days team members are achieving their individual targets. Each business will have different important numbers. Choose a maximum of 5 and make sure there's things that you can measure and you know how you're going to measure them. You need to identify your opportunities and vulnerabilities. You then draw your ideas from these in your plan. Your goal should maximize the opportunities and mitigate the vulnerabilities. Your business plan should have your goals for the year. Make sure these goals are measurable and achievable. They should cascade into 90-day goals with clear actions and a person responsible for each action. Review your business plan frequently to ensure the actions are being completed by the. So how do you actually create a business plan? Well, these are the rules that we follow when we develop and update our business plan, and we also follow them during our business planning sessions with clients. Firstly, all key decision makers should be involved in this session. They must also complete their pre-work. We send this out to our clients a couple of weeks before the session, and this ensures that everyone has taken time to reflect and prepare, and that everyone gets a chance to have their view heard. It also allows us to identify any areas of conflicting opinion or misalignment. This is sometimes incredibly important because if the owners or directors have different ideas of what's happening, one wants to sell in 2 years, the other one wants to sell in 10 years, these things have to come out and be discussed at the actual business plan. We recommend using an independent facilitator. If it's just the decision makers that meet to develop their business plan, it's likely there's going to be some disagreement, as I've already suggested. What happens then? It's also likely that 1 or 2 people will dominate the discussion, others won't get the opportunity to have their views heard. An independent facilitator can help you manage these risks to reach agreement. The business plan should be on 1 page. This may be double-sided, but there's no point in developing a 30-page business plan you glance over once and then put away in a drawer to gather dust. It needs to be visible at all times to ensure it guides your decision-making. You need to share your plan with your team and any other stakeholders that might be involved, might be investors. You might need to cleanse it slightly to remove some sensitive information, but your team should know the plan you have for the business so that they can buy into your vision and align their goals with yours. Report against the plan monthly to see that you're on track and ensure your 90-day actions are being completed and that you're on track to achieving your goals. Review and update your 90-day goals and actions each quarter. Ensure you're on track to achieve your annual goals. Do a full review of your business plan once a year. Some things such as your vision and values may not need to be updated, but take the time to review each section and update them accordingly. So, what will this 1-page business plan actually look like? I'm going to show you an example. We'll work through it. I'm not going to do it in great detail, but hopefully it will give an idea of what it will actually look like. All the components are clearly identified. I like to keep things simple and easy to read and understand. What you see, we've got the purpose, the vision that we talked about. We've got what we want to achieve, and that can come from your personal budget. What do you want to get from the business in the year? What do you want to be doing? Number of hours you're working, holidays, etc. Half day or a whole day exercise in itself to identify. But it's important that you do however you do it. Then we have the budget. This is a high level budget, and we update the year to date column each quarter to show we're on track. Next, we have key performance indicators that have been decided. Again, these will have to be decided, as I said already, through brainstorming sessions, and there's certain processes that we use with our clients to go through to help identify these. The ideal client, the value proposition for your ideal clients. What is it we're here to do for our ideal clients? Then we have our opportunities, vulnerabilities, and a most critical challenge. And on the back page, we record our goals and actions. There's a 1-year goal: improve gross profit to 25% and lift sales to 2.8 million. Then we have a 90-day goal, which basically is what we're going to do in the next 3 months towards achieving that 1-year goal. And we've got the actions that need to be done in order to achieve the 90-day goals. And finally, who's going to do it and when they're going to do it by. There has to be someone responsible. It doesn't mean that person responsible has to actually do the action. It means that they're responsible for it happening, taking place. As I said, we recommend there should be a maximum of 4 goals for the year. So it's really important you get the really important ones. And this ensures that they're achievable and you have time to focus on each goal. So that's the first tool, your annual business plan. If you have any questions about the business plan, remember to put them in the box below and we'll get to them at the end of the webinar. The second essential tool is the annual forecast. Every business needs to have a forecast, even if it's got plenty of money. A forecast can help you unlock a lot of cash just by making a few changes. And the reason for having cash is, well, if you're at the start, go back to February, March time, if you have a lot of cash, you had a much higher chance of success and of remaining in business by the end of the lockdown. Also, in a more positive sense, there could be opportunities that come along. You might think it would be good to have a person with a certain set of skills, but they're quite an expensive salary cost. But if you've got the cash and some other ideal person comes along, you might be able to go for it. Whereas if you haven't, you'll miss an opportunity. And there could be other similar types of situations. So your high level business budget was created in your business plan. What this is, what the annual forecast is to take that and break it down into monthly targets. These targets will account for seasonality and allow you to predict, to prepare for large cash outflows. As with a business plan, there are several components that will make up your annual forecast. You will have a forecast for your profit and loss, cash flow forecast, and a balance sheet forecast. So what might your forecast look like? Right, this screen is not intended to frighten people. It basically, for those who are interested, shows you sales coming in each month. This is the forecast. Cost of sales down here, gross profit percentage, overheads, and your net profit. It's simple as that. And it measures your business efficiency. As its name suggests, this report shows you whether you're going to make a profit or loss each month. It gives you the flexibility to allow for seasonal fluctuations in your business as opposed to lumping all income and expenditure into one annual total. You may find that although there are some months where you're making a loss, overall you're going to make an annual profit, or vice versa. A month-by-month profit and loss forecast allows you to break down the annual numbers you put in your business plan to give you far greater visibility, not only about the detail of income and expenses, but how they're going to be spread throughout the year. And what is really important to understand here is that profit and cash flow are not the same thing. Some costs or cash outlays do not appear in the profit and loss account or the profit and loss forecast. Examples are tax payments, VAT payments, asset purchases, loan repayments, in as much as the part of the loan repayment that isn't interest. The principal repayment doesn't appear in the profit and loss account, but you do need cash to do it. And obviously your drawings. So you need to make sure that you're going to make sufficient profit to cover all these additional cash costs, as well as the profit you want to make in the business. Let's look at the cash flow forecast next. The second report is the cash flow forecast. Now, this report shows all movements of cash in and out of the business on a month-by-month basis. And essentially, it is a prediction of what the bank account will look like, because it looks at cash coming into the bank, cash going out. So if you were hitting exactly your targets, this is what your bank account would actually look at. While the profit and loss forecast shows you your business efficiency, the cash flow forecast shows you whether you have enough cash to survive and thrive. Why would you perhaps have a profit but no cash? Well, maybe you've not been paid. Simple as that. The last forecast to do is your balance sheet. Let's look at that now. Again, a lot of numbers. The balance sheet forecast shows you whether the overall value of your business or net worth is increasing or decreasing. It's a snapshot of all your assets and all your liabilities at any one point. So on the 3rd of September 19, assets included just over £1 million in the bank, £727 money owed by customers, and there were some fixed assets there. So there's 1.956 total assets. And then liabilities were people that were suppliers that had to be paid, a bank loan, and so the total was 473. So the net assets is one take away the other, which is 1.483 million. And you can see if that number goes up, as it does in this instance, the value of the business is, in theory, increasing. And highly profitable companies can and do go bust. So the balance sheet forecast gives you an early warning of risk. For example, if you have a huge increase in sales, but you're slow collecting your debtors, you could be in a position where you can't pay your bills as they fall due, in which case your suppliers, if you don't get paid, will probably stop supplying you, in which case you won't be able to do any work and you won't be able to generate any income, and you effectively go bust even though you're profitable. So the rules to develop your annual forecast. There are lots of different software available that can help you create your forecast. And you should be able to do some of it yourself. Start with your desired profit and then work backwards to calculate the sales you need to obtain that profit. Compare this to last year's results. Is your desired profit realistic and achievable? Review your figures and make any adjustments you need to. Of course, we can help you develop your forecast and identify areas you can improve your cash flow. Now, the final essential tool for business success, the business plan, the forecast, is reporting and accountability. You need to constantly monitor your results to ensure you're on track to achieve your goals. Technology provides you with real-time data, which you can compare against your forecast and make adjustments if required. This helps track your progress towards your KPIs. I'll show you some brief examples of some reporting shortly. The second part of this tool is accountability. You're going to have to make some changes if you want to achieve better results. You will have documented these changes in your business plan, but the risk is that because life is so busy, you just don't get around to implementing these changes. Accountability helps you to set aside time to work on your business and complete the actions you set in your business plan. So who will hold you accountable? The person simply must be someone independent, and they must have the backbone to give you the consequences of failing. They can't be afraid to act or upset you when you need a dose of accountability. They also need to care about you achieving your goals you've set. We call this having a coach with a backbone and a heart. Your accountability coach will ensure that you dedicate the time to look at your numbers as well as to check in that you've taken the actions you need to. Here's an example of a report on your actual profit and loss situation compared to the forecast I referred to before. You can see, you can track whether you're ahead or behind the target and discuss what new actions could be taken to get you back on track. Now, if you look at this one, say for in June, the income was forecast was 600,000, the actual was 180,000, so it's a 422,000 variance, and it doesn't really get much better as time passes. I would suggest that this person probably didn't have an accountability coach because nothing has been done to change, do something. In the balance sheet forecast, you'll be able to see if your business's value is increasing or decreasing in line with your expectations. Again, this one isn't doing too well. You can compare and see if there's any problem areas for improvement. Another reporting tool that some people like is a dashboard. And there's different types, different software will give you different reports. This is quite good for people who are perhaps big picture people and maybe very visual, who can just look at this and understand what it means once it's explained to them, rather than having to look at lots and lots of reports. So it gives you a snapshot of how your business is currently performing compared to your targets in previous periods. So a summary of the things we've talked about briefly. Now remember, the power of 1%. It's a small incremental changes that can have a massive impact on your business over time. If you approach business planning and business improvement looking for a quick fix or a magic bullet, it's unlikely you'll find it. But that doesn't matter, because the 1% rule shows you that small changes can have a massive effect. So it can help motivate and keep you going. You don't have to achieve them a lot in a very short period of time. We also saw what happened to Kodak, MySpace, and Blockbuster. Just a few companies that failed to adapt. Change is essential for survival, because change will happen whether you change or not, and you'll only end up going backwards. And then, of course, we looked at the 3 essential tools for business success. And these are the 3 tools that will help you change, will help you do the right thing, and will help you grow your business. It's a business plan, an annual forecast, and ongoing reporting and accountability. Please take positive action now to implement these tools in your business and ensure its success. We can help you implement the tools in your business. Our business planning service consists of a 4-hour session where we'll develop a business plan like the one you saw earlier. We can also prepare a cash flow forecast for you. If you really want to improve the cash flow in your business, we offer cash flow management coaching, which consists of 4 accountability coaching sessions focusing on cash flow improvement, and they're held quarterly. For those who need accountability to make the changes and achieve their goals, we offer quarterly coaching sessions where we update your 90-day goals and actions and hold you accountable to achieve them. And we also offer a complimentary 1-hour meeting to discuss your goals and find out how we. As I think I said before, one of the biggest problems in business is FTI, failure to implement. If you don't write down the actions you need to take, you just won't do them. What 3 actions will you take after attending this webinar that will add value to your business? Or what projects do you need to begin to start solving the problems you've been experiencing in your business? Doing nothing is simply not an option. Remember, the definition of insanity is doing the same thing over and over again and expecting different results. Do something different. Now I'll hand back to Ikra, who's going to help us look at some of the questions that have been asked.
Thanks, Ian. So, yep, we do have a few questions that came in during that webinar. So if anyone else has got any further questions, please do leave them in the Q&A box and I will read them out to get answered. So I've got one question here.
Okay.
I find it difficult to predict what my future monthly sales are going to be. How would you help me set goals for sales when doing a forecast?
Right. So this business is difficult to forecast the sales. I think what I would do is start talking about well, you'd have to look and see where the business is now. Obviously, first of all, you've got to take a consideration of where the business is. There's no point in just making something out of nothing. But I think we'd have to look at what profit the business, net profit after tax, the business needs to make in order to be able to pay back loans, fund the drawings that the person wants, etc. Once we've got their pre-tax profit, we can work out once we've got their after-tax profit, we can work out the pre-tax profit, and then we can work backwards up to find out what the sales figures need to be in order to provide enough profit for the business that the owner wants. So it's kind of a back to front way of looking at it. In a way, you don't start off with your sales, you start off with your cash requirement, if you like, and then work backwards. And does that make sense? I'm not sure if that makes sense.
Yep, I hope that's answered your question. We've got another question here. Why is it so important to keep an eye on sales, expenses and profit? I just keep an eye on my bank balance.
Yeah, right. Well, I think we possibly touched on that a little bit earlier. A lot of cash items, money that comes out the bank, isn't reflected in your profit and loss account. So in other words, if you, let me think about it. If you have, well, I'll give an example of a client I had many years ago. We had about £70,000, I think, in his bank, and he thought he was doing fine. But he wasn't really doing his bookkeeping properly. So what happened was, all the liabilities that were building up, some of the purchase invoices weren't getting recorded. He wasn't recording his VAT liability anywhere or his pay-as-you-earn liabilities. It turned out that there was about £100,000 of liabilities that were building up that weren't shown anywhere. It was only when people came knocking on the door for money, that when all his cash disappeared, did he realise that if he'd actually been doing a proper profit and loss and cash flow forecast, he would have been able to anticipate this. So that's why it's important. Money in the bank works fine for very, 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 very small businesses, but for larger businesses, it's just far too complicated to look just at one factor.
Okay. We've got a couple of more questions. I really want to be doing more business development work on my business, but I have a really small team and find it difficult to get time to sit and make a plan or a cash flow forecast.
Sorry, I missed the beginning of that. But
sorry, I'll just read that again.
Yeah,
I really want to be doing more business development work on my business, but I have a really small team and find it difficult to get time to sit and make a plan or a cash flow forecast.
Okay. I think what this person's saying is that, well, first of all, we've all got the same amount of time. Nobody has any more time than anybody else. It's what we choose to do with our time that is important. So, although, to be fair, it often feels like we don't have any choice, even though we in essence, we do. What I tend to do is suggest that they get familiar with the achiever matrix that Stephen Covey sort of introduced many years ago. The idea of dividing what you do into 4 different quadrants of urgent or important, and essentially identify the things that you're doing that are not important and not urgent, and get rid of them. Either just stop doing them or find somebody else to do them. And then the things that are not important but urgent, try and find a way to do it. Perhaps outsource, perhaps just delegate it to somebody else. So it's kind of, the idea is that you've got to do the most important things. It's like going to the gym. Going to the gym, some people hate it, but they know that if they don't do it, the long-term effect will be that their body, if you like, will deteriorate. Now, it's a bit like that. It's almost like going to the gym, finding that time, spending the half-hour a day or whatever to sit down and say, I've got to do this, because if I don't, in the long term, I'll suffer. And in actual fact, the point that being made that they don't have enough time is a symptom of not making the time, because they've been busy running around doing stuff that probably someone else could do. Hope that helps.
Yeah. So we've just got one more question. Should a business plan include disaster scenario planning? For example, if another COVID type event happened, should we have a plan for it? Or should the plan focus on a normal year ahead?
Oh, good question. Wish I had a crystal ball. Well, I think these are strange times, and actually did a webinar this morning for Chamber of Commerce on this very topic, really, which was about business recovery planning. I think you have to try to how do I put this? I think you have to make the best judgment you can based on where we are now. I think one of the things I said this morning was that you've really got to work on building up cash. That is the life, it's called life jacket for any business. If you've got, I'll take an average small, decent sized business, if you like. If you've got £100,000 in the bank, that will probably see you through some hard times. If you've got nothing, you've got a £20,000 overdraft, and then suddenly either your sales fall off or there's some sort of other disaster, you're not going to be able to survive. I suppose the short answer would be to do two plans. It's always, in normal times, if you can remember them, what I always used to say to people is do a sort of survival budget forecast. This is what we must do to avoid any problems arising, assuming everything else stays the same. What we'd like to do, then what we'd really like to do. So that way that you can measure against each one and you can see where how you're going. But again, I suppose there's also a very dependent on what type of business you've got. Some disaster planning could mean different things, different types of business. So again, one of the things we touched on was about risk. Again, this morning was going to how likely is something going to happen and how serious will it be if it does. And if something is highly likely to happen and pretty devastating, then you've really got to treat that as a critical issue that you address separately from any other planning. You've really just got to say, right, we need to do something about this now. So you could say that if you took the view that if another lockdown for 3 months happened, that would be highly likely to happen and would be devastating for the business, then you would have to try and put some steps in place to protect against it. But if you thought it wasn't likely to happen, then it's maybe not so important to do something to prepare for it. Complicated question and probably quite a complicated answer. So I hope that answers it a bit.
Yeah, I hope that did answer your question. And that's all the questions that we have so far. So thank you everyone so much for attending the webinar. And we hope to see you on the next webinar.